What is ICT Turtle Soup pattern in the financial markets? How can you make the Turtle Soup pattern a part of your trading strategy to become a profitable trader? What are the ICT trading components or smart money concepts connected to the Turtle Soup pattern? What time frames are best for trading the ICT Turtle Soup strategy? I will answer all these questions and many more in this video. I will also show you many examples of the Turtle Soup pattern from the live market so that you can easily identify the trading opportunities it offers on your chart. Let's begin. Understanding the Turtle Soup strategy requires an understanding of the market structure. The market structure embodies a support and a resistance level. As long as the market moves within that structure, it is range-bound. It moves sideways. But the market cannot move sideways forever. There are catalysts and market participants with different purposes and expectations. There are macroeconomic changes outside the market which influence the market all the time. Besides that, there are you and I and millions of retail traders with our own idea of the market and our own way of entering or exiting it. The market must move away from its structure in search of a new structure based on our needs and outlooks. Now, to create a new market structure, the market must move beyond the support or resistance levels. For long trades, it must rise above the resistance. For short sellers, it must fall below the range. Once the support and resistance are broken, the market moves out of the range. In other words, when the market does not move sideways anymore, we have a breakout. There are many traders who only trade breakouts. Many of the big trades come out of the breakout pattern. Breakouts are worth waiting for. However, if you are a breakout trader, you know how many times you are stopped out of the market by fake breakouts. The market leaves the range but quickly returns to the range and even moves in the opposite direction of the breakout. There is nothing to be surprised about that. Breakouts are a part of the market. In the same way, fake breakouts are also a part of the market. The ICT Turtle Soup strategy tries to identify these fake breakouts to make a profit out of them. Trading fake breakouts means trading the ICT Turtle Soup strategy. Fake breakouts offer precise entry points. They suggest a higher profit target. One of the reasons for that is that once the liquidity is absorbed below or above the market structure, the market moves to the other end of the structure to grab the liquidity there. That means the market moves from one extreme end of the structure to its other extreme end, capturing all the liquidity on its way. Most traders believe that the market will move in the direction of the breakout. But that cannot always happen. That will be against the existence of the market, as the market is based on unpredictability. It is based on the math of probability. It is based on supply and demand, on the theory of liquidity and bias. You see, a swing high is considered a resistance for a long trader and a support for a short seller. In the same way, a swing low is a support for a long trader and a resistance for a short seller. That is why a long trader places their stop loss below the swing low, and a short seller places their stop loss above the swing high. Those stop orders are mostly placed around the same price levels. They are market orders. For long traders, they are sell orders. For short sellers, they are buy orders. When the price of an asset, for example, a forex pair or stock or crypto arrives that level, those orders become market orders. The market must absorb them immediately. If it cannot, if there is a lack of opposite orders to absorb them, market imbalance or inefficiency occurs. What does that mean? If a market wants to rise above its structure, that is, if it wants to move beyond the swing point, it must have more buy orders than sell orders at the swing point area. If it wants to continue in the direction of the breakout, it must have more buy orders than sell orders in the buy-side liquidity zone. In the absence of enough buy orders, the market must make a U-turn and return to the structure. On the contrary, if the market wants to fall below the swing low or the lower end of the market structure, it must have more sell orders than buy orders to absorb them at the swing low point. Then, it must have even more sell orders in the sell-side liquidity zone if it wants to continue in the direction of the breakout. But it is the nature of the market to look for easy liquidity available, which attempts to change its direction to the sell-side liquidity zone for long traders and to the buy-side liquidity zone for short sellers. As an ICT trader, you are aware of the smart money's behavior in the financial markets. You exploit this turtle soup opportunity to enter the market against the breakout, whether long or short, and make a lot of money. Now, how to identify a fake breakout? Number 1. Look at the volume. The volume will be high during the breakout, but going into the liquidity zone, it will slow down. That means the market is absorbing the liquidity resting there. It will return to the market structure once the liquidity is absorbed. When the volume slows down, it is an indicator to the market that the spike is over. Trade orders begin to appear in great numbers against the spike, helping the asset head to the structure it just broke. Number 2. Check a higher time frame. You can form a market bias by looking at the higher time frame. If the market breaks out against the trend on the higher time frame, it will ultimately succumb to the bias on that time frame. If you are trading a 15-minute chart and the market breaks out above or below a swing high or low, the market will have the tendency to give up the breakout if it goes against the market trend on the 4-hour chart. If you are trading on an hourly chart, check the daily chart to form your daily bias. The market is likely to get exhausted and give up the breakout on the daily chart. That is why you must make higher time frames a part of your trading strategy to be a profitable trader. Number 3. If the market is entering a bullish or bearish order block as a result of the breakout, in most cases it will reverse the breakout and move towards the other end of the structure. Order blocks are well-established zones where institutional traders have many limit orders open. Those orders must be filled before the market can fall through the order blocks. The market needs real momentum to undo the order blocks or to convert the order blocks into breaker blocks. In most cases, the market will reverse from the order blocks. Thus, the breakout will discontinue. ICT traders trade order blocks because about 70% of cases, the market respects the order blocks. That suggests that about 70% of breakouts happening at order blocks will end up becoming fake. Number 4. If the breakout is at a market inefficiency zone, which the ICT calls a fair value gap, it is very likely to end up becoming fake. The concept of the fair value gap in ICT is that the market reverses at the fair value gap. Even if the market arrives at the fair value gap as a result of a breakout, the fair value gap is still a proof of the market's imbalance. It can heavily influence the market's trajectory. ICT traders consider the fair value gap an important trading zone. They will buy at a bullish fair value gap and sell at a bearish fair value gap. They only escalate what is supposed to happen at those price points. Those price points are famous for severe price volatility. If you do not understand liquidity, order blocks, volume, market bias, market structure, and the fair value gap in ICT terms clearly, subscribe to my channel and watch my videos on ICT smart money concepts and ICT trading strategies. I truly believe implementing ICT concepts as part of your trading plan will make you a profitable trader. ICT explains how the institutional money behaves in the market. If you follow institutional traders, creating a sustainable trading career is only a matter of time. Be it Forex, indices, crypto, and stocks, ICT offers you high-probability setups. Trade those setups, and you will be highly organized as a trader. You will not depend on speculation. You will not trade impulsively. You will trade less, but earn more from the markets. After all, making a good income from the market is what brings us all to the market. So consider subscribing to my channel so you do not miss any trading video from now on. How to trade using the ICT Turtle Soup strategy. Do not catch a falling knife. Let the breakout happen. Let the market enter the liquidity zone and absorb all limit orders resting there. Wait for the market to retreat back into the market structure. Now you can enter a trade opposite to the breakout. You are not a turtle trader who trade genuine breakouts. You are a turtle soup trader. You trade fake breakouts or unsuccessful breakouts. You trade against breakouts. If the market has fallen below a resistance after briefly rising above it, you will short the market. If it has fallen below the support and has now returned to the structure, that is, it has risen above the swing low, you will go long. Now I will show you some examples of the turtle soup pattern from various markets. Look at them closely to understand what you should be looking for on your chart when you sit before your trading platform. Find these patterns and trade them. Do not be afraid to stand before the market. Take a measurable trade, determine your risk and profit prior to entering the market. Take one trade at a time so that you can monitor how the market behaves with your money once you are in a trade. If you are new to trading and find it difficult to identify breakouts, you may use a breakout indicator on your TradingView chart. For example, Breakout Finder by Lonesome the Blue. Once you see a breakout signal, you know the space is of great importance to you. You may not trade the breakout if it is against the trend on the higher time frame, but you may trade the turtle soup if the breakout ultimately fails. Do not take the trade if it goes against the trend on the higher time frame. Do not take the trade if you are trading a 5-minute chart. A 5-minute chart, compared to a 4-hour chart, will still offer the market plenty of liquidity within the market structure to be temporarily bullish or bearish without destabilizing the market trend. Trade the turtle soup strategy on a minimum of 15-minute chart, 30-minute chart, hourly chart, or a 4-hour chart. If you are a day trader, you may check the market trend on a 4-hour chart and the hourly chart before implementing a trade on the 15-minute chart. In all cases, trade with a stop loss and target a 1-to-3 risk versus reward. If such a ratio is not on offer, do not take the trade. If the turtle soup pattern is faced with a long-established resistance, do not take the trade. As far as I can understand, ICT offers you a 70% win rate. That is more than enough to be a profitable trader. You should be a profitable trader if your win rate is as much as 35%, provided your winners are big and losers small. To be a profitable trader and to remain profitable throughout your trading career, let your winners run as much as it is reasonably possible. Reposition your stop loss so that your gains do not suddenly disappear if the market goes against you. Unrealized gains are also your gains. They are real money, your money. Do not leave them at the mercy of the market.